Welcome to the Deep Dive. Today we're diving deep into the world of Nestlé, a company that's been navigating, well, a truly fascinating mix of high-stakes challenges and strategic shifts. Our mission is to cut through all the recent information and bring you the most important insights. Let's get right into it.
Okay.
So, the most immediate and frankly pretty surprising news around Nestlé has to be the sheer leadership instability.
Yeah.
We're talking about a global titan, right? A company with, 250,000 employees, tens of billions in sales, yet they've seen 3 CEOs in just 1 year. That's just an incredible amount of churn, isn't it?
It absolutely is. And it's highly unusual for a company of this, immense scale. This rapid succession has definitely sent, jitters through the investor community.
Right.
What's particularly revealing is the specific timeline. The predecessor to Laurent Freixe was actually ousted for underperformance after years of a sluggish share price.
Okay.
Then Freixe himself, after serving for only about a year, was dismissed in September 2025.
Yeah. And if I recall correctly, Freixe's dismissal wasn't about financial performance, was it? It was more of a serious governance issue.
Precisely. A governance investigation confirmed he had an undisclosed relationship with a subordinate, which violated Nestlé's code of conduct. The initial tip-off actually came through Nestlé's own Speak Up hotline. And, external investigators found clear evidence despite initial denials.
Wow.
Both Freixe and the employee ultimately left the company. So following this, Philipp Nevertil, a 49-year-old Swiss internal hire, was rapidly promoted from CEO of
Nespresso, okay.
Yeah, he's known for his innovative approach, particularly in coffee, and, his talent for simplifying complex operations.
So on one hand, that quick promotion of an internal guy, it sends a strong message, right? Nestlé upholding its values, acting decisively.
Yeah.
But on the other hand, elevating someone with maybe less regional CEO experience right after all that turmoil, does that signal a stable path forward, or could it be a risk in itself?
Well, that's a critical question. Nestlé has explicitly stressed that no one is above the rules, and they do have the data to back it up.
Okay.
Their Speak Up hotline received over 3,000 conduct reports in 2024 alone. 644 were substantiated cases, leading to 119 employee departures.
That's significant.
It shows a very strong, some might say ruthless, stance on governance. However, if we connect this to the bigger picture, this repeated leadership turmoil is undeniably damaging Nestlé's credibility.
Sure.
It raises questions about their succession planning, and it comes at a time when the company is already battling significant headwinds. Weak growth in China, persistent margin pressure, stiff competition.
It just compounds things.
Like a compounding problem, exactly.
That makes perfect sense. And all those factors really begin to paint a clearer picture of why Nestlé's share price is down. What is it? Approximately 30% recently. It's clearly not just one single issue, is it?
No, not at all. It's like a perfect storm of several core reasons that have converged. Beyond the leadership instability we just discussed, which has severely shaken investor trust and, raised questions about their internal governance, we're seeing a critical issue with slowing volume growth. Nestlé calls this real internal growth, or RIG.
Your RIG, right?
So while their overall organic growth in the first half of 2025 was positive, 2.9%, almost all of that, a whopping 2.7%, came simply from price increases.
It's raising prices.
Yeah. Actual consumer purchases, the RIG, contributed only a meager 0.2%.
That's such a crucial distinction, isn't it? That most people might miss growth from simply hiking prices versus people actually buying more stuff.
Absolutely. It tells you demand is, soft. Another significant concern is the drag from China.
Yeah, you mentioned China.
Sales in Greater China fell over 4% in the first half, with a sharp 10% drop in the second quarter.
10%, wow.
This was primarily due to distributors reducing excess inventory, what they call destocking. Considering China is a strategic market for future growth, this is weighing heavily on investor sentiment.
Understandably.
And then there's the relentless margin squeeze. The underlying trading operating profit margin, what Nestlé calls UTOP, dropped from 17.4% down to 16.5%.
Okay.
That's a 0.9 percentage point decline, largely hit by inflation in key ingredients like cocoa and coffee. For instance, profitability in their confectionery division plunged to just 11%.
11%. Ouch. So rising ingredient costs are truly eating into their profits. Beyond those sort of macro pressures, are there any operational issues adding to the pain, things they aren't getting right internally?
Yes, there are also noticeable execution gaps. persistent issues, things like pet care capacity constraints, underperforming businesses like Gerber baby food,
Gerber, yeah.
and the ongoing portfolio cleanup in their health science division, VMS. It all suggests Nestlé hasn't quite fixed the basics across all its operations.
Right.
This collection of factors is creating a profound sense of investor unease, and that's directly reflected in the share price.
Okay, so it's clear the big numbers tell a story of aggression. Let's dig into the profit margins a bit more. Many analysts point straight there. What's really hitting Nestlé where it hurts? What's gnawing away at the bottom line?
Well, the decline in profitability is multifaceted. Their gross margin fell by 0.6 percentage points. That's primarily down to higher input costs for essential ingredients. Coffee beans, cocoa, various packaging materials. They're simply more expensive to buy right now.
Okay, cost of goods.
Exactly. At the same time, Nestlé actually increased its advertising and promotion, or A&P spend. It went up by 0.5 percentage points to 8.6% of sales.
So they're spending more on marketing.
Yeah, it shows they're reinvesting heavily, trying to support their brands and fend off competition. On a slightly more positive note, admin costs saw a small saving, about 0.1 percentage point, due to efficiency efforts.
A little bit there.
But the net result of all these factors, as we noted, was that UTOP margin falling down to 16.5%.
It's interesting to see where those pressures are felt most acutely, though. Are some categories significantly more profitable for Nestlé than others? Is it spread evenly?
Oh, absolutely not evenly spread. There's a stark profit chasm within Nestlé. They're highly profitable categories. The real cash cows include pet care at 22.1% margin and milk and ice cream right up there at 22.3%.
Wow, those are healthy.
Very healthy. Nutrition and health science also shines at 20.7%, and powdered and liquid beverages, think coffee mainly, comes in at 19.1%.
Okay.
But on the weaker side, confectionery's margin, as we said, plunged to just 11.0%, heavily impacted by that surging cocoa inflation. And water also struggles a bit at 9.7%.
Right.
This breakdown really underscores the urgency for strategic action in those struggling divisions.
That's a very clear picture of the internal profit landscape. Now let's maybe zoom out again and look at how Nestlé performed across its different geographical regions. Did any particular areas stand out for better or worse?
Looking at regional performance, the Americas, or AMS, saw sales of nearly 17 billion Swiss francs, with 2.1% organic growth. However, that real internal growth, RIG, was actually negative, minus 0.5%.
So again, mostly pricing.
Almost all pricing, yeah. North America itself was largely flat, but Latin America was strong with 5.5% organic growth, mostly from passing inflation costs on to consumers there.
Okay.
In Asia, Oceania, and Africa, or AOA, sales were about 10.4 billion Swiss francs, 2.4% organic growth, but again, RIG was negative, minus 0.3%.
Same story.
Yeah. And as we mentioned, Greater China was a significant drag, down over 4% organically.
Right, the destocking effect.
Exactly, especially in Q2. However, AOA, excluding China, actually shows strong growth, plus 4.3% thanks to good contributions from India, Asian markets, and the Milo brand.
Interesting split there in Europe.
Finally, Europe, with over 8 billion Swiss francs in sales, delivered a solid 3.5% organic growth, which is pretty good considering how price-sensitive consumers are there.
Very price-sensitive.
Yeah, but Nestlé managed this through innovation and strong brands, with RIG only slightly negative at minus 0.2%. Pricing did the heavy lifting at plus 3.7%.
Okay, so it's clear performance really varies across the globe. Let's narrow our focus now to specific product categories. Give us a more granular view of what's truly working and what maybe isn't within Nestlé's vast portfolio.
Sure. Well, coffee and beverages remains a powerhouse. It hit over 12 billion Swiss francs in sales with a strong 6.4% organic growth.
Solid.
Yeah, fueled by Nescafé, Nespresso, and the Starbucks at-home products. What's striking here is that this category showed pretty low elasticity. Meaning these products are sort of must-haves for consumers. Even when Nestlé raised prices significantly, over 5% people kept buying. That led to positive real internal growth, plus 0.6%.
Impressive resilience.
It is.
Yeah.
Nespresso alone contributed over 3 billion Swiss francs in sales, with 5.8% organic growth, quite balanced between price and volume.
So coffee is definitely resilient. How about pet care? That's another often cited strength, right?
Pet care generated over 9 billion Swiss francs in sales, but only 1.3% organic growth. Interestingly, though, this category actually saw positive volumes, plus 1.8% REG, despite slight price reductions in some markets.
Oh, positive volume.
Yeah. They did face some supply chain constraints in wet cat food production, but new capacity is expected soon, Q3 in late 2025.
Okay.
Long-term, Nestle sees big growth potential in pet therapeutics, vet-prescribed foods. They currently hold only about 10% market share there.
Really? Only 10%.
Yeah. So with rising pet adoption and premiumization trends, that's a significant potential upside for them.
That does sound like an area with real long-term upside. But what about the struggling confectionery division you mentioned earlier with the low margin?
Right. Confectionery, just under 4 billion Swiss francs in sales. It showed 8.5% organic growth on paper. However, this growth came entirely from raising prices by over 10%.
10.6% pricing. Wow.
Yeah, just to offset that relentless cocoa cost inflation. This led to a volume decline, minus 2.1% RIG, indicating high elasticity.
So people just stopped buying as much chocolate?
Basically, yes.
Yeah.
Here, consumers are very price sensitive.
Yeah.
Even a small price increase makes them pull back, suggesting they have alternatives or are just willing to forego these items.
Yeah.
As we highlighted, it remains Nestle's weakest category profit-wise.
Makes sense.
Then there's nutrition and health science, over 7 billion Swiss francs, zero organic growth. Flat.
Oh, okay.
It's a real mixed bag. Nutrition, particularly Gerber baby food, was weak in the U.S., seems to be losing relevance.
Yeah, you wonder what's going on there.
It makes you wonder, yeah. Meanwhile, infant formula did better in Asia. Health science saw strong performance in premium vitamins and supplements, but the mainstream, sort of value VMS brands, are under review for possible divestments.
So cleaning up the portfolio there, potentially?
Potentially.
Any other notable category performances, quickly?
Prepared dishes and cooking aids, just over 5 billion francs, actually had a slight organic growth decline, minus 0.9%. Indicates overall weakness. The frozen pizza in the U.S. is apparently showing signs of recovery.
Okay, some hope there.
Milk and ice cream had low growth, plus 1.1%, mostly from pricing. And finally, water at 1.6 billion francs showed fairly balanced growth, plus 3.7%, between pricing and volume.
Okay, let's circle back to China for a moment. It's clearly a critical market, and you mentioned this China reset strategy. Can you explain what that actually entails and why it's so important right now?
Sure. The China reset is a fundamental and, frankly, probably painful shift in Nestlé's entire approach to that market. The old growth model relied heavily on a push strategy.
Push?
Yeah, basically shipping massive volumes to distributors. While this looked good on reported sales figures sometimes, it often left products just sitting, aging in warehouses. That ultimately erodes consumer trust and loyalty, especially around freshness.
Right. Not ideal. So what's the new way?
The new strategy is a pull model. It's driven much more directly by actual consumer demand. The focus is on freshness, having fewer trade stocks clogging up the system, and much faster innovation to meet local tastes and trends.
So it's really about quality and consumer trust over just sheer volume being pushed out the door. What's the immediate impact been? You mentioned the drop in Q2.
Exactly. And yeah, this transition has naturally caused some short-term pain, as we saw in the second quarter of 2025's over 10% organic growth decline in China.
Oof.
Yeah. But the long-term goal is to achieve truly sustainable growth and rebuild greater trust with consumers in that incredibly dynamic and, well, important market.
It's definitely good to hear they're directly addressing a core issue like that. Speaking of addressing issues, Nestlé is also actively identifying and working on its weaker spots across the entire business, right? How are they tackling these underperforming cells, as they call them?
Yeah, they refer to these as their 18 underperforming cells, and collectively they represent a pretty significant chunk, 21% of their total sales.
21%, okay.
The good news is there seems to be some progress. The drag from share loss in these businesses has apparently been reduced by more than 1/3 in just the past 6 months.
That's quite fast progress.
It is. They've pointed to successful turnarounds in areas like Milo and ASEAN, biscuits in Brazil, soluble coffee in Europe, and that frozen pizza recovery in the U.S. we mentioned.
Okay.
However, some areas are definitely still lagging. Gerber baby food in the U.S. is a notable example, again, having lost shelf space due to, well, weak products and positioning. So it's a mixed bag, some success, but ongoing challenges too.
Understood. Now, coffee. We keep coming back to it because it's undeniably a powerhouse for Nestlé. What's the competitive environment looking like in that category, especially with recent industry news about potential mergers?
Yeah, Nestlé remains, a global leader in coffee with its formidable portfolio, Nescafé, Nespresso, Starbucks at home. Hard to argue with that.
Right.
However, an interesting wrinkle is emerging. The potential merger of Keurig Dr. Pepper, KDP, and JDE Peet's.
That talk.
If that deal goes through, it would create a combined entity with a significant 16% market share. That would definitely intensify the competitive landscape.
16% is not insignificant. How is Nestle viewing this potential development? Are they worried?
Well, Nestle's public perspective is quite strategic. They believe stronger competition can actually expand the entire coffee category.
Interesting take.
And they expect to benefit from that overall category growth while their rivals are busy with the inevitable complexities of integration.
Ah,
Post-merger integration is never simple.
true.
And an interesting side note here is their partnership with Luckin Coffee in China. Apparently, they're launching new products almost weekly together to boost demand and stay really agile in that fast-moving market.
Weekly launches, wow, that's agile.
Mm-hmm.
Okay, that's a proactive approach. So beyond these specific categories and regions, what concrete steps is Nestle taking overall to execute its strategy and improve performance? What are the big levers they're pulling?
They have several key initiatives underway. First, there's the Fuel for Growth program. They're targeting 700 million Swiss francs in cost savings for 2025.
700 million.
Yeah, and they've apparently already achieved 400 million of that in the first half.
Good progress.
How? The tactics include things like leveraging AI in procurement, global sourcing, operational efficiencies, and simplification of their regional zones. Basically trying to run smarter, leaner operations.
Makes sense.
Second, under what they call big bets, the focus is on fewer, bigger, better innovations. They've already had 65 market launches in the first half, which have generated 200 million Swiss francs in incremental sales.
Any examples?
Examples include new coffee creamers in the U.S., that Milo turnaround in ASEAN, and the frozen pizza recovery. So trying to get more bang for their innovation buck.
Right.
And finally, they're really trying to capitalize on their digital advantage. Nestle boasts a significant digital edge with, get this, 500 million first-party consumer records.
500 million, that's huge.
Huge. Plus a single ERP system globally for streamlined operations and AI-powered marketing tools designed to optimize promotions and advertising return on investment. This gives them a real competitive moat, you know?
That digital and data capability sounds like a major differentiator, yeah.
It really could be.
Okay, we've discussed a lot of challenges, and it sounds like Nestle is really fighting on multiple fronts here. But for those listening, maybe looking at Nestle's long-term prospects, are there any silver linings? Any potential opportunities that might not be immediately obvious given the recent news?
Absolutely. I mean, from an investor's perspective, it's important to see both sides. There are several positives you shouldn't ignore.
Okay, like what?
Well, those strong categories like coffee, still growing over 6% organically, and pet care, with positive volumes and that significant potential in premium therapeutic diets still in the early stages, those remain powerful growth engines.
Right, the core strengths.
Exactly. There's also the resilience they showed in Europe and Latin America, managing solid organic growth despite really tough consumer environments. And that Fuel for Growth plan seems on track for the 700 million Swiss francs in cost savings for 2025.
And they're reinvesting that.
That's the plan, yeah. Reinvesting into marketing and innovation, which could definitely pay off down the line.
And that digital advantage you just mentioned must be a positive, too.
It truly is. Their digital and data moat, with that 500 million consumer records, the AI-driven marketing and supply chain, the single ERP system, it provides a competitive advantage that few global CPG companies can replicate.
Mm-hmm.
And, you know, the new CEO, Philipp Navratil, his strong coffee track record, his innovation mindset, relatively young leadership profile, he could be a stabilizing force if he delivers consistency and drives results.
Big if, but potential.
Potential, yes.
Huh?
However, we absolutely must acknowledge the short-term risks. Margins are likely to face more pressure in the second half due to those ongoing high cocoa and coffee costs.
Still working through the system.
Exactly. The China reset strategy will probably weigh on results for another 12 months or so. And investor trust, well, it remains fragile after the recent governance scandals. It takes time to rebuild that.
So definitely a mixed picture, but maybe some potential for the future if they can navigate these challenges effectively.
I think that's fair. And if we connect this to the bigger picture, the shares have corrected significantly by approximately 30%. That makes valuations look potentially more reasonable compared to the historical premiums Nestle often commanded.
Right.
They still retain that unmatched global scale, the powerful brand recognition, and clear category leadership in key areas like coffee, pet care, and nutrition. So if CEO Navratil can genuinely stabilize the leadership, deliver on those promised cost savings, and really reignite meaningful innovation, then maybe the current price could mark an attractive entry point for long-term investors.
Food for thought.
Which, raises an important question for you, the listener, to think about. Considering all these intricate moving parts we've discussed, the leadership, the costs, China, innovation, what do you think will be the single most crucial factor for Nestlé in navigating its current challenges and really leveraging its enduring strengths in the coming years?
That's a great question to ponder. We've taken quite a comprehensive journey today through Nestlé's recent corporate and financial landscape, hopefully painting a detailed picture from leadership changes to strategic shifts and right down to category performance. Now, just a quick but very important note for you. We are not certified financial advisors, and this content is purely for educational purposes.
That's right.
If you are considering making any investment decisions, please consult a certified financial advisor